Thank you for joining us from wherever in the world you are this morning. Good morning once again. My name is Abiodun Kerikwe, and I will be your host and moderator for the session today. This is the Afrinvest H1 2022 and the H1 2022, H2 2022 review and outlook of the Nigerian economy and the financial markets. Afrinvest Research and Consulting, by the way, is a leading provider of world-class business and market insights across various industries, asset classes in the frontier, emerging and developed markets. We are an integral part of the Afrinvest West Africa Group, which on its own is a leading wealth advisory firm with nearly 3 decades of experience in 5 principal areas, covering investment banking, securities trading, asset management, trusteeship, and investment research and consulting. Our half-year report is themed Still in a Rabbit Hole. I particularly like this theme because it succinctly captures the current predicament of the global and domestic economy and raises the question of how anyone can find peace and growth in a rabbit hole. Our seasoned presenters are Benedict Egochukwu, Daniel Onosoya, Miriam Olabode, and Mobifoluwa Adesina. Before we begin, I have a few housekeeping notes. This webinar basically is being recorded, and the recording will be made available post-webinar for everyone's viewing. If you have any questions for the presenters, please use the chat feature. You can also submit a question or any other inquiries about our products and services via our group email. For technical questions, you can reach out directly to me via the chat function on your email, or use the email, which is aresearch@afrinvest.com for help. To not waste much of our time and just to get us straight into the business of the day, let's welcome our first presenter in the person of Benedict Egochukwu, who will take us through the developments in the global economy and basically the global section of today's presentation. Benedict, thank you for being here today. The floor is yours.
Thank you for having me. Thank you everyone for making out the time out of your busy schedule to join us. Good morning once more. So I'll briefly be taking us through the global macroeconomic environment, all that happened in the first half of 2022, and our expectations moving on for the rest of the year. Thus far, there are 4 major economic conditions that have shaped the global economy in 2022. They include inflation, geopolitical tension in Eastern Europe, the lingering pandemic concern, as well as the monetary policy tightening. And what we've seen so far is the crystallization of these headwinds have stoked fears amongst investors, causing negative reaction in both the commodity and financial market and fueling concerns of an imminent recession. But we're gathered here to ask ourselves, how did we get here? What has the demand-supply balance at play and at work in 2022 look like? And what do we expect in the coming months? If we recall, in 2020 and 2021, the economic growth performance was largely structured by all the developments surrounding the COVID-19 pandemic. As such, in 2020, we saw a recession with a contraction of about -3.1%. However, in 2022, we saw a recovery of around 6.1% year on year, and this was largely driven by the policy support from both fiscal and monetary authorities. Then on the back of this growth, we expected that in 2022, growth was going to continue in the same direction, although at a moderate level. But entering into 2022, we noticed that the outlook was a little bit blurry, as evidenced by the IMF in its World Economic Outlook for January, which showed a downgrade from their previous forecast of 4.9% in October 2021 to 4.4% for the year. Fast forwarding a little bit into the year, we saw the invasion of Russia inside Ukrainian soil. And what we noticed after that was that this set off a caused humanitarian and economic crisis, further denting the global economic outlook. As such, in the IMF's World Economic Outlook for April 2022, growth was further downgraded to 3.6%. And we're already getting a hint that IMF is going to bring this growth forecast a little bit down once more, moving on in the coming months. Now, if we take a look at the regions across the board, we saw a growth moderation as well. In the advanced economies, growth is expected to slow down to 3.3%, down 0.6 percentage points. And this is as a result of a slow pace in growth from both Canada, US, UK, EU, and Japan. As well, in the emerging market and developing economies, we expect a downgrade of 1 percentage point to 3.8%, and this is due to China, India, ASEAN 5, and Russia having a downgrade in their growth forecast. Contrary to what we've seen across other regions, the SSA region is the only region that received a growth boost to 3.8% from 3.7%, and this is due to the region's oil exporters. Now, we want to take a look at the demand and supply play at work that we've seen so far in 2022. Like I stated earlier, the recovery in 2021 was largely supported by various stimulus packages that was issued by both the fiscal and monetary policy. As such, we saw demand grow largely. But on the supply side, there was a lot of constraint because of the COVID-19 disruption. And what we saw on the supply side was port shutdown, some outbreak-induced factory closure, worker shortages, as well as congested shipping. Consequently, inflation rose to levels above pre-pandemic levels, especially in areas where recovery was strongest in the United States, in the United Kingdom. In a bid to kind of curtail inflation, what we noticed was that global systemic central bank began to adopt an aggressive hawkish stance. And what we have in front of us, we can see the advanced economy. In the United States, so far in the first half of the year, we've seen 3 consecutive rate hikes in a total of 150 basis points to the range of 1.5% to 1.75%. And the rate hike is not expected to stop, as by year end, we're expecting it to increase to the range of 2.5% and 2.75%. Similarly, in the United Kingdom, we've also seen 5 consecutive rate hikes from a low point of 0.1% to 1.25%. And it's expected by the end of 2023, this should increase all the way to 3%. But contrary to what we saw in the United States and the United Kingdom, in the European Union, rates was unchanged throughout the first half of the year as they kind of investigated the impact of inflation on the economy. But in July this month, we expect a 25 basis hike in interest rates. And this is going to also continue moving forward. While in Japan and in China, we've seen interest rates stay at all-time low level or unchanged in the case of China. This is just kind of help the economy recover. Now, if you look at the SSA region, the emerging market economy, we'll find out that similar to what we are seeing in the advanced economy, we also see something likewise. Please, next slide. In Nigeria, we saw interest rate hike of about 150 basis points to 13%, while in South Africa, we've seen 4 consecutive rate hikes so far to a region of 4.75%. And in Egypt, we've seen all key policy rates rise as much as 300 basis points in May. And moving forward, we expect that in the emerging market, they will be cautious as to how they increase rate, although we have one outlier, which is Ghana, because the latest inflation report that came out from Ghana suggests that inflation rose to as much as 29.8%. So we expect to see more hawkish stance in that region. Now, if we take a look at the global supply chain as well as the global trade at large, in 2020, trade was basically supported, or demand was basically supported by the various stimulus, as earlier mentioned, while supply chain was constrained. But in 2021, we saw that the supply chain strain eased off in some part of 2021. As such, global trade rebounded in 2021, with trade value growing as much as 25% year-on-year to 28.5 trillion naira, outperforming pre-pandemic level of around 13%, while the trade merchandise volume rose to as much as 3.8%. This was basically on the back of slowdown in infection rates, abating pandemic restriction, increasing commodity price, as well as a strong recovery in demand. In 2022, what we're expecting is that growth will moderate to around 3%, and this is actually a downgrade from the previous forecast of 4.7%. And the downgrade is hinged on the back of elevated inflation and the ongoing crisis in Eastern Europe, which is between Russia and Ukraine. Now, looking at some part of the supply constraints, particularly oil prices, we find out that in 2021, the Brent crude oil price averaged around $70.86 per barrel, and this represented a 68.9% year-on-year, following a rebound in demand amid constrained production and supply capacity. Coming into 2022, we're expecting that supply was going to outpace demand, but that has not been the case so far, especially in Q1 2021, where we saw demand remained upbeat as expected, but the shortfall in supply continued, and this was just resulting from the rising geopolitical tension, as well as OPEC Plus inability to meet targets. Hence, oil price at the end of Q1 2022 averaged around $100.87 per barrel, which represented a 42.4% increase from full year 2021 figures. In the second quarter of 2022, we saw the supply deficit increase further, and this was because of the escalation of the Russian-Ukraine crisis. So in an attempt to kind of plug the gap, the US and the International Energy Agency tapped into their emergency reserve, while on the part of the OPEC Plus, they agreed to increase their monthly quota. As such, supply received a boost, but on the other hand, we noticed that demand was affected, and this was following the lockdown measures that was implemented in China following the resurgence of the Omicron variant. Hence, at the end of Q2 2022, we saw Brent crude oil price average around $113.84 per barrel, which compared to what we saw in Q1 2022 was not that much. It represented an increase of 12.9% year-on-year. For the rest of 2022 in the oil market, we expect that oil demand is going to increase to about 99.7 million barrels per day, and this will be on the back of the recent ease of restriction in China, the winding down of some refinery maintenance in the United States, and pick up in summer driving and jet fuel demand. On the supply side, as earlier mentioned, supply is already on the rise, but we expect that in a situation whereby there's any supply shortage, the IEA Strategic Petroleum Reserve will plug the gap. So towards the end of the year, we hope that the oil market is going to normalize. Nonetheless, some of our downside risk factors to our projections include more sanctions on Russia, sharper Libyan oil output losses, and then the erosion of OPEC Plus spare production capacity. Now, bringing this back all together, as we earlier mentioned, 4 key macroeconomic conditions currently shapes the global economy in 2022. And some of our expectations in these various headwinds include, starting with the inflation. At the moment, we're already seeing inflation hit 40-year highs, especially in the United States and in the UK. Now, recently on Wednesday, the United States released their inflation figures for June, which showed inflation rates rise to as high as 9.1%, the highest we've seen so far in 41 years. Now, moving forward, we're expecting that inflation is going to persist, thus weakening the demand levels. And what does this mean for the consumer? It means that consumers will have to forgo discretionary spending. But on the corporate side, we expect profitability to be dampened, and this will be as a result of a mismatch between stock levels and demand levels, hence a lower earning performance. If we take a look at the Russian-Ukraine crisis, after the invasion, several countries decided to sanction the country, Russia, and that kind of penalize them for their actions. And what we've seen so far is that the EU has agreed to phase out oil imports from Russia in the total of up to 75%, and that number is only expected to increase to 90% at the end of the year, which means in the near term, we expect oil and gas prices to remain on the rise. If you take a look at when it comes to agricultural input, trade sanctions, which were imposed on Russia, is expected to affect supply chain dynamics, thereby increasing industrial raw materials as well as food prices. And what does this mean for the consumer? On the consumer side, especially when it comes to the low-income householders, we expect them to bear the full brunt of the price increase, as most of our spendings or their spending are tilted or spent on food and fuel. While in terms of businesses, we expect that those who are dependent on import from either Russia or Ukraine, they are going to witness a slowdown in their activity. And this is because of a disrupted train link. Moving forward, we think that a resolution to the Russian-Ukraine crisis seems unlikely in the near term and could possibly possibly trigger a recession within Europe. And then just to add the lingering pandemic concern to the mix, you find out that the global chain supply remains vulnerable, and then demand levels are expected to decelerate along with growth prospects. Now, focusing finally on the monetary policy tightening, the staggering inflation we've seen so far, coupled with the Russian-Ukraine crisis, has indeed caused so many global systemic central banks to hike up interest rates. Like I said, it's expected that interest rates are going to keep going higher throughout the entire year. But what we've seen so far is that inflation is driven by structural factors and not necessarily demand factors. So we believe that efforts to further tighten interest rate may not lead to the desired result, which is drawing or bringing inflation back to the target rate. What we actually foresee is that the interest rate hikes may impact or dampen economic activities as well as raise unemployment levels in the economy. So right now, policymakers are confronted with a policy trade-off between curbing inflation and supporting growth in the economy, especially in a period where we're already seeing demand levels weakening. Just tying this all back in a knot, what we're basically saying is, although that all of this has kind of stoked fears in investors, as well as created this negative reaction towards investing either in the commodity or the financial market, and more recently, the notion of recession is in the mind of everybody. We do not see a likelihood of a global recession happening this year, as a modest disescalation in tension between Russia and Ukraine, as well as efforts put into the repairs of global supply chain, could help stimulate growth and ease fear throughout the end of 2022. Thank you.
All right. Thank you, Benedict, for that beautiful and excellent presentation. I hear you say that the global economy is likely not to slip into a recession this year. And indeed, I believe no one is looking forward to this, particularly if you think about in the context that we're just emerging of a recession. Graciously, I do hope that the world can witness a real de-escalation to the tensions between Ukraine and Russia, and luckily, central banks can somewhat begin to slow down on the rate at which they are basically contracting the economies. I believe this would go a long way, in helping to keep the global economy on the path of growth and peace, if you say, after that devastating impact from the COVID pandemic. I have someone's hands raised a moment ago, but I think the hand has been dropped. If you have any questions for Benedict, kindly put them through the Q&A module, or you send them through directly to me via the chat function. We will be able to answer some or all of the questions during the Q&A at the end of the presentation. At this point, we would rotate into the macro part of the presentation, which will be handled by Daniel Onosoya. Kindly join me to welcome Daniel Onosoya. Daniel Onosoya, please take the floor.
Thank you, Abiodun. It's good to be here today. We'll start this section by looking at GDP performance. At the beginning of the year, we estimated that GDP would come in strongly for 2021. And true to this expectation, we saw that GDP grew impressively, and this strong performance was sustained into 2022. As of Q1 2022, real GDP expanded by 3.1%, majorly driven by the sustained resilience of the non-oil sector. On the other hand, we've also seen that the oil sector remained in contraction after a decline for the 8 consecutive quarters on the back of weak crude oil production. For 2022, although the World Bank expects Nigeria's growth to come in at 3.4%, in our own opinion, we are more conservative on Nigeria's GDP outlook. Our conservatism is hinged on the negative spillover effect of the ongoing Ukraine war, particularly on how it has elevated commodities prices and energy costs, and we expect this to linger through the remaining half of the year. Furthermore, the weak crude oil production that has hampered the growth of the oil sector, we believe that this will also be sustained through the end of the year. Added to these two factors is the increased political risk environment ahead of the 2023 general election. We believe that these three factors combined would weigh on Nigeria's growth prospects for 2022. As a result of this, we maintain our projection that GDP growth will come in at 2.9% on a base case scenario for 2022. Moving on, historically, Nigeria has recorded low inflation in pre-election year dating back to 1999 if we exclude 2010. However, we believe that this trend is unlikely to hold this year, given that risk factors have mounted and they have become relentless. In the first half of the year, we've seen elevation remain elevated on the back of weaker naira exchange rates, the higher cost of energy goods and other imports as a result of the war, as well as the prevalence of insecurity that have declined food security in the country. As a result of this factor, we expect price pressure to linger in the remaining part of the year. And against this backdrop, we revised our forecast for inflation upward by 250 basis points to 17.1% on a year-on-year basis. On the next slide, we will see that legacy issues such as suboptimal operational refineries, as well as sustained crude oil theft and pipeline vandalism, coupled with poor infrastructure investments, have combined together to undermine Nigeria's capacity to fully realize the benefit of the oil market rally. That said, the gains from the upswing in average crude oil prices have been much more beneficial on the external front. We will see that on the next slide, that as a result of the higher crude oil prices, Nigeria has been able to record trade surplus for the first time since Q2 2021. For context, in Q1 2021, trade surplus printed at 1.2 trillion naira, driven majorly by surge in crude oil export earnings. And of course, this was as a result of the higher price. So going forward, we expect that crude oil prices would average above the budgeted benchmark. And as a result of this, we expect it to trickle down into higher crude oil export earnings, which will keep trade balance in a positive territory. Nevertheless, we did not see these gains significantly impacting Nigeria's external position due to the fact that Nigeria has consistently recorded net outflows in services and investment transactions with the rest of the world. Now, in spite of the respite that we've seen from trade, data on capital importations continue to trend downward as the protracted capital control measures that the CBN has put in place has left sour taste in investors' mouth. And as a result of this, we've seen that foreign investment inflows into Nigeria have declined significantly in the last 8 quarters. On the next slide, we look at the 2021 budget in retrospect. The budget scorecard shows that the revenue underperformance challenge of the FG remains a thing of worry, as you would see on this slide that for the 2021 budget, actual FG revenue underperformed by about 45.9%. Now, if you look at the expenditure side, you would observe that expenditure was lower by 14%. But mind you, it is worthy to note that this expenditure number is exclusive of expenses from government-owned enterprises, right? Even with this decline in expenditure, we've seen that Nigeria's fiscal deficit widened to 7.3 trillion naira, overshooting the budgeted benchmark by 13.3%. Now, what this tells us that Nigeria's fiscal deficit has been on an uptrend since 2015, as we would observe in this following slide, that since 2015, Nigeria's fiscal deficit have soared by 300% to 7.3 trillion naira. And with the need for this increasing deficit means that the federal government had to plug this funding gap, and as a result have increased borrowings. Now, the double whammy of higher fiscal deficit and increased borrowing have seen the nation's total debt ballooned to 4.6 trillion naira as of Q1 2022. Now, the combined effect of this is that the fiscal sustainability metrics for Nigeria has worsened significantly, and this has further drawn the nation deeper into the rabbit hole. Now, specifically, Nigeria's debt to GDP ratio has expanded to 23.3%, and this ratio was merely 13% in 2015. To make matters worse, right, debt service to revenue ratio has also remained at alarming levels. As of Q1 2022, Nigeria's debt service to revenue ratio printed at 85.8%. This implies that for every 1 naira that Nigeria generates in revenue, approximately 6 kobo is being spent to service debt obligation. In our own opinion, we estimate that if this pace is sustained, then Nigeria's debt to GDP ratio is likely to surpass 24% by the end of 2022. And by 2030, we estimate that debt to GDP ratio would surpass DMO's benchmark of 40%. Now, sadly, this fiscal woes continues in 2022, as we would see in the 2022 budget, that our penchant for increasing expenditure is still very much intact, with our expenditure plan printing at 17.3 trillion naira. However, also we've seen that our preference to revenue projection is also high. If you look at the revenue aspects, we believe that this revenue projection of 10 trillion naira is overly optimistic, given the fact that looking at the first half of the year, Nigeria has struggled to actually achieve this budgeted benchmark of 1.6 million barrels per day. As we've seen in some slide back, that over in the last 6 quarters, Nigeria's crude oil production has been on a declining trend. And as a result of this, we believe that the revenue that is budgeted for oil and gas will come in short, as well as we are also less optimistic about the FG's ability to actually mobilize this 5.4 trillion revenue from independent and other sources. Now, due to all of this, we maintain our beginning year position that actual FG deficits for 2022 may top 10 trillion naira in a base case scenario. In the next few slides, we will look at the development in the monetary policy space. Kindly move to the next slide, please. Yeah, amid all the weak macroeconomic fundamentals, we've observed that in the first half of the year, the MPC raised the benchmark rate by 150 basis points to 13%. As we would also see on the next slide, that despite this increase in MPR to 13%, the pressure on the naira remains largely unabated, and we trace this majorly to the increased risk aversion for emerging markets assets, which has affected Nigeria, as well as the protracted capital control measures that the CBN has also put in place. Not forgetting the episode of policy uncertainties from both the fiscal and the monetary authorities. Now, if you look to the chart to the left, you will see that as a result of the lingering pressure on the naira, the differential between the official rate and parallel market have widened by more than 40% to 188 naira 50 kobo as of May 2022. And as a result of this, we estimate that NAVET rate is currently overvalued and should be trading at around 452 naira 90 kobo to the dollar by the end of 2022. Similarly, for the parallel market rate, we expect it to settle at 627 naira 30 kobo to the dollar by year end. On the next slide, we'll see that the need to attract more FX inflows has prompted the CBN to implement some unorthodox policies. Chief among these policies is the 100 for 100 PPP, that is the 100 for 100 policy for production and productivity, as well as the RT200 FX program. As a bit of a background, the 100 for 100 policy for production and productivity is geared towards select is geared towards making finances available to 100 companies who are focused on non-oil exports, while the RTE 200 FX program is focused on generating $200 billion over the next 5 years in FX proceeds. Now, looking at the LT200 program, through the program, the CBN has introduced an FX rebate scheme, which majorly provides 65 naira to dollar incentive to every exporter that repatriates their FX proceeds through the I&E window for third-party transaction. And since this scheme has been put in place, you have observed significant traction in the I&E window, as you will see on the chart to the left, that inflows from exporter in the I&E window has more than doubled to $2.4 billion. However, our concern is majorly stems from two angles. The first one being the assumptions that underlies this policy. We believe the assumptions are overly optimistic. For instance, if you look at the RT200 program, especially the chart to my right, at the RT200 program, it is expected to be on average $40 billion rather, each year for the next 5 years. And historically, Nigeria has only been able to achieve the highest that Nigeria has only been able to achieve is about $10.5 billion. So we believe this, on this note, we believe that this assumption is overly optimistic. The second leg is we've all heard about the possible stoppage of FX sales to banks. We believe that if this plan progresses, then we are likely to see more pressure on the Naira in 2022. Now, in the next few slides, we'll tilt our focus to the socio-political scene in Nigeria. The first half of the year has been lit up by intense intra-party activities, as we have seen several aspirants scramble to secure their party's tickets. We have also seen emergence of new forces in the likes of Labour Party and the New Nigerian People's Party. In our opinion, we believe that this is positive for Nigeria's democracy. However, as we progress into the second half of the year and the election campaign season kicks off fully, we think that the electorate should consider, we think that these 5 salient points should be top of mind for all the electorates. Essentially, what we are saying is that as the electorate is gearing up for election, we believe that they should consider each or all the candidates based on their will and capacity to actually drive inclusive growth, their capacity to improve security architecture and enhance public sector accountability, as well as their capacity to foster national cohesion and implement the necessary constitutional reforms. No doubt, the job of bringing Nigeria out of this mess is an uphill task, right? Given the fact that insecurity has risen to an all-time high, and the macroeconomic fundamentals remains weak, and our fiscal woes continue to haunt us. Despite this, we have put together 4 pillars that we believe the new administration can leverage on in order to upscale its developmental agendas. As we can see on this slide, these are the 4 pillars. At the middle of the pillar, we have the preconditions that we believe if the new administration can follow it, they will be able to achieve the success factors. You will see the success factors at the base of the pillar. Now, speaking to the first pillar, we believe that if the new administration focuses on enhancing security, improving economic liberalization, as well as eliminating business constraints, the administration will be able to accelerate economic growth. On the second one, we believe that the adoption of market-reflective exchange rate as well as interest rate policy would go a long way in stabilizing our exchange rate. Also, we've seen in previous presentations, especially on the macroeconomic side, that capital control measures has worsened investors' appetite for Nigerian assets, which has in turn affect our foreign investment flow. So we have the opinion that if the new administration could eliminate this overburden capital control measures, we'll be able to enhance foreign investment flow. On the third pillar, which focuses basically on driving positive non-oil exports, we believe that some of the preconditions for this includes eliminating bureaucratic process at the ports, establishing more free trade zones, as well as ending the multiplicity of taxes that have been placed on businesses. And if this is done, we believe more job and wealth creation is likely for the nation. On the fourth pillar, we advocate that the new administration would be able to improve infrastructure development if they prioritize public-private partnership, as well as embrace cost-reflective tariffs on utilities. Now, if all these pillars can be leveraged on in order to boost to upswing the new administration's developmental agendas, we are confident that from 2022 onwards, Nigeria is likely to take a turn for the better. Right. On this note, yeah, I would like to end my presentation and hand over to our host for the day. Thank you.
Wow, wow. Thank you, Daniel. Thank you, Daniel Onosanya. That's a very well articulated presentation. I think it draws from the theme of the report, still in a rabbit hole. I think, and I believe that that theme eloquently captures the Nigerian conundrum as she continues to search for peace, growth, and development, still very much within that same rabbit hole. You can imagine how tough, how complex that search process would be. There is indeed no better time to hope for a strong rebound, in economic growth. Unfortunately, many of the challenges you have identified, which if I can recall, at least I picked a few, you touched on fiscal imbalances, elevated price levels, insecurity, and unfavorable external conditions would keep Nigeria's economic growth tamed at about 2.9% in 2022, based on Afrinvest analyst estimates. More importantly is the fact that we are in a pre-election year, which puts enormous responsibility on everyone on this webinar today, to not just sit on the sideline, to get active, get involved, get your PVCs, and do the needful. To add to that is the fact that you're able to identify about 4 very core pillars for anyone who is standing out there and showcasing themselves as the potential candidates to lead the economy for the next 4, if not 8 years. Thank you for that beautiful presentation once again. To just tell our audience once again, if you have any questions, kindly put them through the Q&A module, or you can use the chat module to send the questions directly to me. From here, we will be proceeding into the next section of this presentation, which focus on the fixed income markets in terms of review and our outlook, and Miriam Olabode will be anchoring that session. Miriam, thank you so much. Please, you can have the floor.
Thank you, Abiodun. Good morning, everyone. And I'll be taking us through the fixed income space. Between 2019 and 2021, monetary policy was accommodative, and this supported global financing conditions and also spurred an increase in the global debt. However, the significant policy support from 2020, which supported demand, led to the historic high inflation rate, just like my colleagues said in the global section. Also, the supply chain recovery was not as strong as the demand recovery. And because of the price pressure, monetary policy turned hawkish. Looking at this chart talks about the monetary policy index. And the red bar indicates the positive index, which shows the monetary policy tightening, while the blue bar indicates the negative index, which shows the global easing. Over the last 3 years, we see that the monetary policy index has been accommodative. And as a result, as of 2019, the index was minus 6.7 points. In 2020, it was minus 10.0. The index was minus 10.0 points, which was the lowest over our period of analysis. However, in 2022, the index stood at 4.0 points, the highest since 2006, and this shows a significant shift in the direction of monetary policy from being accommodative to an hawkish stance. On the impact of the global debt, we know that while the year-on-year debt levels grew by 0.7% in Q1 2022 from 2.4% in Q4 2021. And in our view, we believe this slowdown was due to the shifting of monetary policy landscape rather than a seasonal effect, as the long-term data does not support this as well. And as such, we expect the subsequent year quarterly data to show that the monetary policy is already weighing on the global debts. As you can, moving on into the sub-Saharan Eurobond space, the performance in the sub-Saharan Eurobond space within our purview remained bearish, as average yields rose to 24.9% in H1 2022. And this was largely due to the rise in interest rates hike in the US. The debt issues also was a huge factor, the currency depreciation and capital flight, which led to the repricing of instruments in the SSA Eurobond space. Based on our review, the Zambia 2022 instruments recorded the most sell-offs, with yields rising from 46.6% in the first half of the year to 350.8% in the second half of the year, as the papers nears maturity, coupled with the country's failures to service their obligations amid the physical challenges they are facing currently. Also, the corporate Eurobond in our corporate Eurobond space, the market was also bearish, as the average yield into 12.2% from 3.2% in the first half of the year. And based on that, for our SSA Eurobond space outlook, there's still a lot of risks. There's still a lot of risk factors ahead, given the fact that the external pressures are still mounting. However, we expect the interest shock that affected SSA Eurobond space in the H1 will likely reduce in H2. And that's partly because some of this risk has been factored into the market already. And possible reduction of energy price, which is good. And possible reduction of the energy price, as you can see, the Brent crude oil falling below the $100 per barrel, which is good for energy inflation. And the risk of the recession could also persuade the Fed to be less aggressive. Also, the inflation is significantly driven. As what I'm trying to say is that the good for energy inflation. The factors that we also see that will affect the SSA Eurobond is we expect the monetary policy, the fiscal and monetary authorities in SSA will influence the performance of the SSA Eurobond space. We expect policy responses from the fiscal and monetary policy to influence the SSA Eurobond space. And in some particular countries like Nigeria and Ghana, we have seen efforts to increase government revenue by introducing new taxes. Also, we do not rule out the possibility of debt and budget restructuring when and where necessary. And this will aid the debt sustainability as well. And as a result, we expect these policies to provide comfort for investors to continue to play in the Eurobond space. And also, due to the sell-offs that occurred in the first half of the year, Eurobonds have become cheap, and in first half of the year, and in H2 2022, we expect investors to cherry pick good. We expect investors to pick instruments with good fundamentals that take the fact that Euros have become cheap, and based on what is going around the market. So, moving on into the domestic fixed income market, the first half of the year was marked by buoyant system liquidity, which prompted a bullish trend across the fixed income space, except the NCB space. 62% of the estimated liquidity inflow in 2022 materialized in the first half of the year, roughly up to 4.6 trillion. In the secondary market, automobiles declined by 16 basis points to 5.3% year-on-year, and this was driven by the liquidity environment, especially CBN moved to keep marginal rates unchanged at the primary market auction, even as it undersold automobiles by 10 billion in the H1 period. For the T-bill space, which bucked the bullish trend, the trajectory was guided by the CBN's move to peg interbank rates to the asymmetric corridors of the MPR. And as a result, they were repricing of bills to keep the market attractive. For bond space, despite the federal government front-loading its 2022 borrowings, rate declined as the DMO kept a lead on the stock rates. And based on this move, alongside the increase in maturities and increase in ways and means financing, kept the bulls in play for the first half of the year. And for our corporate issuances, at the beginning of the year, we predicted that there will be more corporate issues. And as you can see, for the commercial paper, it increased to 487 billion in the first half of the year at an average rate of 11.3%. Also, there were corporate issues as bonds with an total outstanding value of 13.5 billion at a coupon rate of 13.3%. Based on what we have and based on what is going to happen in the second half of the year, due to the shift of focus to the electionary activities, we believe corporates will be hesitant to borrow significantly as the more business uncertainties in the 2023 election. For our domestic fixed income outlook, our outlook is based on key factors, and these key factors will shape the fixed income yield environment: the supply-demand factors, the hawkish domestic sentiment, and the elections uncertainties. In our domestic outlook for 2022, we predicted an increase in domestic bond sales to exceed the 2.6 trillion, projected to an estimate of 3.1 trillion in 2022. As you can see on this chart, this domestic borrowing target for 2022 is 3.6 trillion. And looking at the first column, the federal government bond issuance and T-bills sums up to roughly 2.6 trillion, which means the amount left to be borrowed is 1 trillion. But if you look at the third column, we see that the addition of the federal government bond issuance, T-bills, and ways and means sums up to roughly 4.1 trillion, which indicates that the 3.6 target can be met. While our forecast was spot on, the shelving of further Eurobond sales for the remainder of 2022 after the $1.2 billion issuance in the first half of the year. This means the domestic target might increase to 5.6 trillion because the federal government tried to recover the rest of it, decided not to borrow from external sources due to the hike in interest rates. And due to that, the domestic target might increase to 5.6 trillion in 2022. And as a result, the DMO will most likely go to the local markets for additional financing. And based on the new estimates, there will be legroom for issuance of up to 3.6 trillion in the second half of the year. However, we estimate the total inflows in H2 2022 at 2.8 trillion compared to the 4.6 trillion that was recorded in the first half of the year, with the federal government's coupon point payment accounting for 15.9% of the total inflows. Also, we still entertain the possibility of HOMO rate hikes to incentivize foreign portfolio inflow as part of attempts to improve attractiveness of the Naira assets. And our view is premised on the decoupling of monetary policy rates from key market rates, including the OMO rate. And for instance, although the MPR was unchanged at 11.5% in 2021, OMO primary market rates were adjusted upwards by the CBN in Q1 2021, and that was to lure hot money into the system and driving the short end of the curve upward in the secondary market. And in the same vein, the outcomes in the recent pre-election years environment associated with the have pointed to an uptick in yields as well. And this trend can be explained by the social unrest, uncertainties in business environment, which is associated with the pre-election permutations, combined with the need for better real returns amid the inflationary pressures. It will also price into the yields as well. And considering these factors in play, we expect federal government yields to close the year at around 12.7% compared to what was recorded as at December last year, which was 11.5%. However, the downside risks to our forecast will stem from the uptrend in the ways and means financing, a pause in the global hawkish policy bias, which could also dissuade the anticipated OMO rate hike by the CBN, and also the leaning of the DMO towards the external and debt and towards the external and concessionary debt sources is also one of the key risk factors that is going to affect our forecast for the rest of the year. And as you can see, based on this, as at the beginning of the year, we had an investment strategy where we recommend some vital portfolios to our investors. So at the beginning of the year, our strategy for the investors at the short end of the curve, our strategy for the investor is to play at the short end of the curve. And this was informed by the expected bullish momentum in the period. Based on that, a review of the performance of our recommended portfolio for the H1 2022 shows an average return of minus 5.9%. And for our modified duration bond portfolio, it returned 2.6% below the S&P bond index of 9.1% as of the first half of the year. And this underperformance is largely due to the rotation of the investors, mostly to the mid end of the curve rather than the short end of the curve that was predicted, that was advised at the beginning of the year. On the other hand, our smart euro bond portfolio returned negative 20.8% against the JP Morgan bond index of minus 18.9% in H1 2022. And also our domestic corporate bonds returned 0.5% during the year as well. But based on our strategy for the rest of the year, for our modified duration bond portfolio, our strategy is that investors should optimize the yield curve and look for opportunities across maturities. And for our smart euro bond, we still maintain our buy and hold strategy recommendation, as the interest rate shock we expect the interest rate shock to also reduce in the second half of the year. And for our passive bond portfolio, we maintain our existing strategy as well for investors to continue to hold. And based on all this, if you would love to further discussion on how to take advantage of opportunities in the market in H2, our asset management and securities team are ready to provide support and insights. So kindly drop your contact and we get in touch with you. Thank you, and that will be all.
All right, Miriam Olabode, thank you so much for that very insightful presentation. Candidly, the crux of the fixed income market so far this year is pretty much how the macroeconomic environment has somewhat made it tough for fixed income traders, to make money so far this year on behalf of their clients. while the DMO and the CBN continue to enjoy the flexibility of easily influencing market rates to the advantage of fiscal objectives. That said, but if you had seasoned fixed income traders such as my team at the Afrinvest Securities trading team, or well-informed asset managers such as my team from the Afrinvest Asset Management Limited team, right? Who have been able to employ and deploy both traditional and non-traditional trading strategies to navigate the market and help clients make money this year, I can assure you, you did be smiling right now. But in any case, should you wish to take advantage of this market skill set to either enhance your wealth creation objective or enhance your portfolio performance, do not hesitate to reach out to me directly. I will gladly put to action your request. That said, the last two sections of the presentation, which is the fixed income, and the next, which we're about just going into, the equities section, pretty much focus on how you, as my audience, can make money in this market, despite all of the negative headwinds or headlines we've been hearing so far. This last section also promises to be quite juicy and insightful in terms of how the equities market has performed this year, and to perhaps, to your amazing surprise, you did be shocked as to how well, amidst all of this negativity, some investors have been able to make very decent returns this year. This then leads me to bring on board Mobifoluwa Adesina, who would be taking us through the equities market review for the first half of the year and sharing his perspective in terms of outlook for the rest of the year. Mobifoluwa Adesina, you're welcome. The floor is yours.
All right, thank you very much, Abiodun, for that introduction. Good morning once again, everyone. And like Abiodun mentioned, I'll be taking us through the equity section, talking about the performance, talking about the factors driving this performance, as well as the outlook for the second half of 2022. So without further ado, I would like to go right into the presentation, starting with the performance in the first half of 2022. No doubt, the market was quite interesting for the first half of 2022, like Abiodun mentioned earlier. I mean, a lot of investors cashed out, made some money out of the market. And this, we believe, is on the back of a mix of factors, such as the exciting corporate actions, impressive 2021 corporate earnings, dividend payments, as well as the robust system liquidity in the system in this period. Another factor that we would like to point out is the fact that the market is sort of concentrated in few stocks, like some few blue chip stocks such as Dansem, MTN, and Airtel. And what this means is that any positive performance from these blue chip stocks would definitely impact the market positively. And despite the rising inflation, rising fixed income yields environment, as well as the recent CBN office tilt. So now let's talk about the activity, the performance in terms of activity. When you look at the chart to my right, you see that the most volume was seen in May, about 400 million units was sold in this period. And this is the reason for this is not far-fetched, considering the commencement of the business, PSB businesses of MTN and Airtel in this period. We believe that this is one of the factors that this is a major factor that contributed to the volume that we've seen in that particular period. Now over to the value chart. As you can see, the most value was seen in January, with over 368 billion naira in January, and this is mostly due to the fact that we saw a new listing in the market, talking about the Boa Foods listing on the NGX, as well as the frenzy that comes around with the ushers in the earnings season at the beginning of the year. So now, having talked about the what happened in the market, the performance in the market in the first half of 2022, it is also important to now talk about the participation in the market in terms of foreign and local participation in the market. Now, the foreign investors, as you can see on the next slide, shows that the foreign investors remain aloof in the market due to the foreign liquidity issues that we are currently seeing in the economy. And as a matter of fact, these foreign investor participation in the economy declined by 13.4%, as you can see on this chart, as of May, given the 50 billion net outflow that we've seen in this period. Why we believe that this low participation of the foreign investor is bad for the market, it is also a blessing in disguise. I mean, it's sort of guided the NGX from the possible sell-off which could have been induced by the Ukraine-Russia war, as well as the rate hikes in the advanced economies. I'm also interested to know that the NGX was the second best performing market in H1 2022. Now, proceeding to the sectors where investors actually put their money in the first half of 2022. This takes me to the next slide, where I talk about the sector performance of the NGX, of the stock markets in the first half of 2022. Now, if you look at the charts to my left, you see that the sector performance was largely bullish, as 4 out of the 6 indices that we cover at Afrinvest gained in the markets. And specifically, we can see that 2 of these 4 sectors actually outperformed the market, talking about the oil and gas sector gaining over 49%, and talking about 58%, and talking about the Afri-ICT, which gained 47.2% in this period. So now, trying to paint a perspective as to the factors that actually drove this performance by these 2, by oil and gas and Afri-ICT, to mention a few of them. For the oil and gas index, we allocate this performance to the rising global oil prices and the interest in companies with outstanding performance, such as Seplat, which is an upstream company. Also, when you look at the performance, when you look deep into the telecoms sector performance, you see that this is basically reflective of the impressive earnings and the start of the PSE businesses of the big telcos, as I mentioned earlier during my presentation. So now, in terms of our projection, and this is captured on the chart to my right, I mean the table to my right. In terms of our projection for this sector in the coming months, starting with the big guys, I mean the top guys in the market right now, based on their performance in the first half of the year, talking about the oil and gas sector. We expect that oil and gas sector will continue to enjoy the gains of the rising oil prices going forward into the second half of the year. However, our major downside risks include the insecurity issues that we're currently facing in the country, how this affects the companies and their profitability. Also, we look at the foreign exchange issues, liquidity in the market currently. This is also a major risk factor to weigh on our outlook for this sector. Now, moving to the telecoms sector, which we at Afrinvest, we benchmark with the Afri-ICT index. We expect that recovery of the subscriber base and the deployment of the 5G infrastructure is expected to attract interest to attract more interest into this sector going forward in the second half of 2022. Now, for this outlook, major downside risks include FX issues, as we've been saying, as well as vandalism. Also, another major factor is the regulatory strains and how this can impact the performance of the sector players. All right, so now trying to sum all of this together, trying to marry all of these things that we've been discussing together and moving to our projection for the entire market, as you see on the next slide. So if you recall, we prognosed at the beginning of the year that the NGX would return a gain of 13.7% for 2022. However, after our critical analysis of the market, talking about the factors, talking about the performance in the H1 and the factors, the current dynamics in the market, we have modified our projection to 19.1%, which we believe will be shaped by 7 key factors, including talking of the corporate earnings, fixed income dynamics, Ukraine-Russia war, interest rates, direction of global systemic banks, yield movement in the fixed income market, as well as the domestic monetary stance of Nigeria. So now I won't be taking all of this one by one, but I'll just touch on a few of them, like in order of importance to me. So we believe that the sharply hike rates and worsening foreign exchange conditions would continue to prop up outflows, and this might, if care is not taken, this might extend to the second half of the year. However, on our optimistic case, we foresee that, okay, if we see some sort of moderation in or slowdown in the rates at which rates are being increased or hiked globally and domestically, as well as improved or more clarity in the foreign exchange market, we believe that this would help to reduce the level of net outflow out of the country. Also, talking about the fixed income environment, just as my colleague Miriam has earlier painted for us, if in the fixed income market we see some sort of increase in the fixed income yields, we expect that this would lure investors out of the equities market into some more attractive fixed income instruments going forward. However, on our pessimistic case, we opine that if the fixed income yield is flat, if the fixed income yield reduces, this would help to bolster interest in the equity space going forward. So against all of these backdrops, we now project that like I said earlier, that the NGX will gain 19.1% in 2022, indicating a moderation from the current performance of the H1 at 21.3%. So in terms of valuation for the market for NGX is currently undervalued relative to peers in the BRICS region, and we expect this undervaluation to further deepen, going forward into the second half of 2022. So for context, we expect that the price to earnings ratio would continue to decline, to 9.6 times from 10.6 times as of June 2022, due to the expected slower EPS growth. By EPS, I mean earnings per share growth of 19.3% against the 90.8% that was seen in the previous year. No doubt, this is an opportunity, but possible higher yield environment in the fixed income is a major threat to this outlook, to this opportunity. Now, if we were to switch positions, the question I would be asking you right now would be, how do I position in the market to have a decent bite of this opportunity? So this takes me to the next slide. So this takes me to the next slide, where I talk about our investment strategy as a firm. So to help you position, we have put together 4 portfolios for you. all for you to help you position. As you can see on the chart to my left, you see the banking quality portfolio, which returned, as a bit of review, which returned 1.1% in the first half of 2022. You also see the value portfolio, which returned 15.3%. And thirdly, you see the dividend income, which returned 9.8%. And specifically, if you look at the fourth one, which is a growth portfolio, which returned 29.9%, even outperforming the markets. This is quite interesting. I mean, like, so for the rest of 2022, we are retaining all the constituents of this portfolio, except the dividend income portfolio, which we have rebalanced to meet our selection criteria. So by and large, we are confident that that our strategic portfolio mix would return value, I mean strong value at the end of 2022. So why we see a lot of opportunities in the market, it is also important to know that you need to collaborate with a trusted broker, such as the Afrinvest Securities Limited, to help hold your hands through the market, to help you understand where to invest, when, and how to invest properly for maximum value in the market. And this is basically because of the current macroeconomic headwinds in Nigeria, as well as the market uncertainties. So this brings me to the end of my presentation. Thank you for listening.
All right, thank you, Mobifoluwa Adesina, for that insightful presentation on the equities market. Clearly, you've been able to touch on the key performance and drivers of the equities market so far this year. And from your presentation, it became obvious that despite the negative headwinds that we've seen and experienced so far this year, there is so much of potential that the domestic equities market can offer you and myself as investors and players in this market. There were reported interesting corporate actions, very juicy dividends, there were decent dividend payouts and growth, and most importantly, strong capital appreciation. A plus 21% returns half year is quite compelling, particularly if you dimension it in the context of the elevated inflationary environment, and the sort of positive net returns you get, or real returns you get from that singular activity. Like Mobi had said, should you require any form of assistance to navigate the domestic equities market, please do not hesitate to contact anyone, myself, anyone else on the team, or our securities trading team via email or through any of our social media platforms. They are readily available and willing to handhold you through this journey of playing both the fixed income and the equities market domestically. Already, this brings us formally, officially to the end of the presentation. So we are now rotating into the Q&A sessions. Clearly, we have questions that have been coming through the Q&A module. I see a handful of them have already been responded to and taken care of. But I guess the last segment of the questions are perhaps for the presentation or the presenter for the equities market. The first one from Patrick Katunaya here says, what's the reason for the bearish sentiment on GTCO stock? And a follow-up question from him saying that Seplat has huge arbitrage play between the Nigerian exchange and the London Stock Exchange listings. That this is totally explained, this is not totally explained by the FX differentials and what exactly is going on. While we put that question into perspective, we have hands raised from Gabriel Okoro. If Gabriel Okoro, if you're able to unmute yourself rather, kindly proceed to ask your question. Administrator, can you unmute Gabriel Okoro to ask the question? I have two hands raised, one from Gabriel Okoro, Samson Owolabi. I'd like to take them as on the basis of as it comes. So Gabriel, kindly unmute yourself to ask your question.
Hello?
Yes, we can hear you.
Okay. Thank you for the presentation. I just want a bit of clarification. I think Patrick has also asked something related to that. I also want more clarification. The increase we saw in the oil and gas sector, apart from Seplat, is there any other firm that also shows such promise? You know, is there any other firm that we can base their performance, we can look at their performance and say, okay, this is the reason for the increase we are seeing in that particular sector, excluding the performance for Seplat shares. And also for Seplat, the almost 100% increase in share price that we saw, is it actually based on their performance, or that foreign investors or those looking to take their money out of the economy see it as an opportunity to actually take their funds out, given that it is also listed on foreign exchange? So essentially, is the increase based on performance, or investors looking to leave the market are using that as an exit window? Thank you.
Oh, right. Thank you for that question, Gabriel Okoro. If I can quickly respond to that, Seplat, so far this year, even coming from 2021, if you've been tracking the performance from the financial perspective, you clearly see that the company has been able to maintain very strong financial performance, which is driven by two key factors: the fact that they're able to sustain solid or robust production levels in terms of their core productions, and additionally by the external factor, which is the recovery in crude oil prices, right? And this clearly has supported the financial performance of the company so far in 2021 and into the first quarter of 2022. And we actually expect that that performance will be sustained through the rest of Q2 and in fact for the entire 2022. On the other side of the question, clearly we cannot rule out the fact that from the time we had COVID-19 struck since 2020, there were certain type of foreign investors that were stuck in the market or trapped in the domestic market, given the FX issues that we've had and the fact that some of these investors could not easily repatriate their funds, be it in form of capital gains or dividend returns, you know, or fundamental, the initial funds that were invested in the market. So clearly we cannot rule out the fact that the investors or the foreign investors are taking opportunity of that cross-border listing to also create liquidity and exit window for their holdings in the domestic equities market. Thank you, Gabriel, for that question. We'll take a question from Samson Owolabi now. So Samson, you can kindly unmute yourself and ask your question. Okay, Administrator, can you help unmute, or can you grant Samson Owolabi the right to unmute? In fact, we have about 4 hands raised. Kindly grant them the right to unmute themselves ahead. So
Okay, thank
Samson,
you
the
very
floor
much.
is
Can you hear me now?
Yes, we can hear you.
Okay, yeah, thank you very much. I want to commend your nice presentation. And I want to ask a question. My first question goes to is on the fixed income parts. I was want to ask a question based on the fact that recently in the year, the federal government suspended their $950 million Eurobond borrowing due to pricing issues. So on that particular note, and looking at how the CBN increased on monetary hike rates recently, on that particular note, I want to ask that what's the trade-off, looking at the trade-off, what's the best option for the federal government to borrow right now? Is it still in the external markets or still in the internal markets? Also not knowing that recently there might be another interest rate hike maybe this month and during the MPC meeting based on the fact that inflation is still like skyrocketing. So what do you think is going to be like the best option for the government? Is it external or is it internal? That is number one. And number two, I want to ask a question on the equities part, and that is concerning the telecommunication sector. What do you think about the recent PSB license granted to MTN and the one that was also granted to Airtel? What do you think? Like, how do you think it's really going to like affect their stock market? Do you think it's going to affect this their pricing this quarter, or are we going to be looking at maybe next year? Like, what is really the effect going to be? Is it going to like show up on the half year, or is it still going to like, or we should be expecting maybe a positive or a negative outcome in the next year, or maybe in the next 12 months? And finally, I want to ask also that this is concerning the interest rate hike. I want to ask that what do you think about hiking interest rates? Like, do you think is like the best policy or the best option for us? And do you think there's a time lag between the efficiency of the interest rate hike and when it is like, for example, if they hike the rate now, like what's the time lag between before we see the effects? Do you think there's a time lag between when they hike the rate and when the effects is really showing up? And I also want to understand your view about how major central banks of the world are hiking rates, but we can see that the likes of Japan and China, they are still like maintaining the dovish policy. Do you think it's still like the best option to go dovish, or should they go hawkish? What is the trade-off between those decisions? That's just my question. Thank you very much.
All right, thank you, Samson Owolabi. You can mute yourself now.
Okay, looking for the option.
All right, thank you once again. I think that's a whole load of questions put together in one. I will try to make sense of a few of them. I believe already that the presentation so far already speaks or answers a good number of your questions. So I would like to speak to the question around what do we think in terms of where the DMO or the government will be sourcing for or looking at raising debt from. Already in terms of the policy on ground for which guides the DMO in terms of where they source or raise debt from. That document stipulates that currently they should do 70% domestic and 30% external, right? Given where we are now, I think in terms of the external borrowing, we're already somewhat above that threshold. Perhaps we're very close to the 40% level in terms of the share or the proportion of total borrowing versus the source, so domestic versus external. So that then leaves a bit of headroom for the DMO to look more domestically in terms of raising debt. And I think the DMO somewhat has communicated or signaled that ahead. And another reason why that is easy or comfortable for the DMO to do is it gives them that flexibility to actually determine the prices and the rates which they would like to raise these debts, particularly when they have to keep debt service debt service as a proportion in perspective. Again, what then that means is for the external environment, we're currently seeing global central banks are increasing interest rates. And again, that means, for instance, the US economy will perhaps be looking more attractive in terms of rate. And that puts pressure on frontier and emerging markets also. And you would likely want to follow suit to raise rates, which then means it becomes a bit more expensive for the government or the DMO to pursue external debt funding or debt raising a bit more aggressively. Yeah, I think that's the bit of the question I can speak to. I think the rest of the questions are well taken care of by the presentation. In terms of the overall outlook for interest rates, domestically, you get a sense, if you follow closely, you get a sense that there is clearly a disconnect between the monetary policy rate, whether either an increase or a decrease, and what you find in terms of actual market rates. There is a disconnect. Markets seem to track more what happens at primary market auctions and the rates at the secondary market auctions, both for the OMO auctions and the treasury bills and the bond auctions. So that's the rate that market looks more to take guidance from, in terms of making sense of interest rate direction. And for the global landscape, I think clearly what we're seeing is each economies are adopting strategies to either make their own economy look attractive to the rest of the world or defend their economy from possible shocks, external shocks. And as such, you will probably continue to witness a bit of divergence in terms of how global central banks are reacting to some of the challenges and the risk factors in the global space right now. In terms of the fear of a recession, it seems more like the euro area is perhaps at the risk of a recession more than any other economy on a global platform. So you perhaps would expect a different type of policy reaction from the euro area compared to what you find from, or how you'd expect the US to react, or the Bank of Japan to react to some of these challenges that we're currently seeing. With that, we'll quickly take the next question from Chinaka Jude Wakwe. Chinaka, please unmute yourself and kindly limit the question to 1 or 2 so we can be able to accommodate a few more questions. I can't seem to hear you, Chinaka, if you're speaking. All right, for whatever reasons, I can't hear Dr. Chinaka Jude. I would have to move on to Emmanuel Odedino. Perhaps I'll come back to Chinaka Jude. Perhaps he needs to look at his audio connections. That way we'll be able to hear you. So Emmanuel Odedino, kindly proceed with your question.
Okay, my question is on the equity slide. I hope you are hearing me.
I can hear you loud and clear.
Yeah, my question is on the equity slide, the last presentation before the question and answer. And on the right side of that slide, there is a red color and the green color, and then there is the exit and the entry arrows. I'd like some explanations because the presenter didn't talk about that side at all. I'd like to know what the...
Thank you, Emmanuel, for that. Slide modulator, can you please roll back the slide 1 or 2 steps so I can see the slide where the question is from on. If I can make sense of it, in any case, that slide is speaking to what we call our portfolio recommendation. There are portfolio recommendations that we've created and we in fact put together as as an index, which they are actually publicly tradable, and you can access them via the NGX trading platforms. They are managed in conjunction with the NGX, really. So what that slide basically is showing you is that at the half of the year, when we conducted what we call a rebalancing exercise to ensure that all of these constituents of the index or the portfolio still meets the criteria for being included in that index. Some of them at the end of the period, perhaps due to changes in terms of financial or other metrics, will no longer meet the inclusion criteria. So as a result, they will be excluded from the index, while new stocks or new tickers that meet the inclusion criteria then comes into the index. What this index does for you as an investor is it helps you take away the headache, right, of thinking about what stocks to buy, what composition of stocks should I put together in my portfolio. You can easily mirror this index as an investor, and basically your portfolio can mirror the performance of the index also. Thank you so much, Thank you so much, Emmanuel Dedino, for the question. So we can take the question from Dr. Chinaka Jude Uwakwe now.
Hello, can you hear me now?
Yes, I can hear you loud and clear.
Okay,
Thank you.
Thank you for the presentation. So my question, I'll go direct, is about compound interest. So which portfolios can one, go into and start benefiting from this compound interest? Because I've been looking at the stock market and I don't know how compound interest plays or comes into buying into stock market and holding it for long. So I don't know. You can tell me the portfolios where we can benefit from compound interest. Thank you.
Oh, I think that's a very interesting question, right? Compound interest in stock market investing. I think in any ways, right, by default, your returns in the market is compounded, right? If you assume you purchase a stock at the start of the year, December 31st, for instance, you bought maybe Zenith Bank shares at, say, maybe 20 Naira, right? And then by half year, that share price had rallied from 18 Naira to 22 Naira. Roughly, you're doing maybe 15% return. That's pretty much the return for that stock for that period. Now, if you're not looking at compounding such a return, then that means you have to be looking at either rotating out of that investment with both your capital, initial principal, plus the interest, and then reinvesting all of that in another stock. Another way compound interest will work in the stock market will be when you're invested in a particular stock, you get your capital appreciation as it is. You don't realize that, you don't crystallize that capital appreciation until the day you exit from that stock. But while you're holding on to that stock, while your capital appreciation is compounding, you're receiving dividend returns, dividend incomes. You don't expend that dividend income on your personal self. You then reinvest the dividend income. That is another way of compounding your returns in the equities market. For the fixed income space, how it works is you have to keep rolling over both your principal and the interest at the end of the expiration of your investment period. So if you bought a treasury bill or you invested in a government bond for, I'm just speaking hypothetically, say for 1 year or 2 years, at the end of 2 years, when you get your principal and interest paid back to you, you go back and reinvest both the principal and the interest, perhaps in the same instrument if it's still available, or in another instrument that is open. And that way you're then able to compound both, you're then able to earn interest on the interest you've earned earlier, and while also you're earning new interest on the capital you have invested. So that's pretty much how compounding works, both in the fixed income and in the equity space. It's just slightly different when you think about it in terms of equity investing. I hope that takes care of the question. I still have Samson Owolabi with his hands raised. Can you unmute yourself? Okay, while that is going on, I think it was high time to respond to a question from Patrick Atunaya on GTCO. If I can make sense of the question, what's the reason for the bearish sentiment on GTCO? Recall that GTCO went through a bit of a restructuring where it then adopted the holdco structure. And on the back of that holdco structure adopting, the bank opened up its business, or pretty much diversified its business, and began to look into payments, into asset management, funds management, and a few more new income heads, right? That is expectedly meant to begin to add to the bottom line over a period when the bank is able to sweat these businesses. To push the agenda for that, the bank had gone ahead to acquire the funds management business of Investment One Financial Services, if I recall appropriately. And then there are a few more internal restructuring that is going on within the bank, all geared towards helping the bank diversify its income sources in an environment where the traditional banking model is increasingly facing new type of competition from the mobile banks and the payment service banks and the fintechs that are also coming into the space to compete with them. So clearly that is driving the performance behind the bank. And if you recall 2021 coming into Q1 of 2022, the financial performance from the bank also had not been as very compelling as some of the peers within the tier one industry, tier one space in the banking industry. So while investors are trying to make sense of that entire restructuring from a normal banking model to the holdco banking structure, and also looking at the underwhelming financial performance and trying to make sense of this, we begin to see this bearish sentiment. I personally believe that this sentiment would correct with time when the bank is able to then consolidate its numbers and begin to report very decent numbers on the back of the holdco restructuring that we've seen. And perhaps for us at Afrinvest, GTCO is one of our rated banking stocks, which we think over the years have been able to deliver impressively, both in terms of profitability and cost management. And as such, it still remains within our radar and meets our stock recommendation criteria. So that is pretty much what I can say about GTCO. So I see a few more questions here. I will also like to know where to get it on the CBN's data. Okay, I think that is a reaction to a question, maybe reacting to the question about the ways and means. Our analysts will point you in the direction of where you can get data on ways and means from the CBN website. Another question from Islamiat Onifade: what's your view on upside for MTN stock? If I recall correctly, our upside target for MTN is in excess of 20%, driven by, based on our valuation at Afrinvest, driven by the strong play that MTN has come to deliver in the telecom space. MTN is clearly an industry leader, controlling more than 18 million subscriber base in the telecom space. Company has remained very, very consistent in terms of delivering strong financial performance, both in terms of revenue growth across its core business subsidiary or core business segments, strong profitability at the end of the day also. These are very good indicators that gives us comfort at Afrinvest, and we continue to believe that MTN would outperform and deliver returns in excess of 20% over the next 12 months based on our target price and upside potential. Okay, I think that will be all of the questions I can see here. I would like to rotate back to Samson Owolabi, pardon me, if you're able to unmute yourself now, kindly proceed with your question.
Hi, Abiodun. Do you want me to ask my question again, or because
Okay, I think okay, so I was wondering, your hands were still raised. I think I responded to your question, and I said some of the,
sorry,
your hands were still raised. Yeah,
yeah,
that was
my questions already. It's fine. Cool.
All right.
Yeah,
thank you so
very
much, Samson. Yeah. So do we have any more questions that we've not reacted to? Okay, I think we've taken all of the questions. All of the questions in the Q&A module have been responded to by our analysts directly to the in code to the questionnaire. So yes, I think that's well taken care of. Emmanuel Odedino, please explain okay, we've responded to that question also. Yes, so thank you so much. I think with this, okay, I think I have a new hand raised. Ayo Sonyaolu. I have Ayo Sonyaolu raised. Please proceed with your question.
Somebody asked a question for the differential between Seplat price on the London Stock Exchange and the Nigerian Stock Exchange. We've not heard the answer to that.
Oh, I actually responded to that. I recall I said it is not out of place to adduce that differential to the fact that we've had foreign investors that were trapped in the market since 2020 when COVID-19 struck, and on the back of that, they were looking for strategies of how to exit the market. And where you have stocks that have this dual listing, such as Seplat, I think Etel Africa also enjoys this dual listing status. You begin to see that bit of extra attention and extra traction towards these stocks, because investors are able to if eventually trade on these stocks on dual exchanges. So yes, that is my response to that question.
Well, it's actually cheaper on the London Stock Exchange. It's about 100 a pound. That's like 750, and on Nigerian Stock Exchange about 1,300.
Yes, and if you add to the fact that for Seplat, they've reported very strong financial performance so far. Speaking from an insider perspective, so far this year, we have seen very, very strong interest from our clients for Seplat, particularly, especially as we continue to see the crude oil markets enjoy very strong rebound on the back of the tension between Ukraine and Russia, and the fact that global economic activities are recovering also. And most importantly, that if you look at the share of domestic participation in the Nigerian equities market, it has risen quite significantly higher than foreign participation. So this domestic interest is clearly driving and supporting interest in some of these stocks that are enjoying this dual listing. All right, that will be it. I think all of the questions have been taken care of at this point. So this now the complete officially brings us to the end of this presentation session. As requested for, we will be sharing both the access to the video and the slides for the presentation and access to the full report at the end of this webinar. I want to say thank you. I want to thank everyone who has taken their time from the start of the presentation to the very end. From the numbers I saw in terms of participants, it was quite interesting and compelling to see that we had very high levels of engagement from the start, and that engagement was retained even to the very end of the presentation. Thank you so much, everyone. We look forward to doing this again with you, hopefully sometime in 2023, January 2023 to be specific. Our asset management subsidiary also has a webinar scheduled for, I think, 21st of July, which should be next week. It's going to be another explosive and interesting webinar as a focus on what you should be doing or how you should be reacting to this great inflation that we are all experiencing. I look forward to having you on that webinar. Thank you once again, and do have a great weekend from myself and my entire team and the entire Afrinvest people. Thank you. Goodbye.